Why can the base effect make inflation numbers misleading? Have you ever wondered why inflation numbers can sometimes seem confusing or even misleading? The answer lies in something called the base effect. This concept plays a significant role in how we interpret inflation rates, especially headline inflation. The base effect occurs when we compare current inflation rates to price levels from a previous time, often the same month or quarter from the prior year. This comparison can distort our perception of inflation. It is important to understand that inflation is measured by calculating the percentage change in a price index, such as the Consumer Price Index or the Harmonized Index of Consumer Prices, between the current period and a base period. If prices were unusually high in the base period, the current inflation rate may appear lower than the actual price increase. This situation is known as a high base effect. On the other hand, if prices were unusually low in the base period, the inflation rate may seem artificially high, which is referred to as a low base effect. This happens because percentage changes depend on the size of the base value. For example, if a price index rises from 100 to 150 in 1 year, that is a 50% increase. If it then rises from 150 to 200 the next year, the percentage increase will only be about 33% because the base is larger. In the context of headline inflation, which includes all items like food and energy prices that can be volatile, base effects can cause significant fluctuations in reported inflation rates. A sharp rise in energy prices 1 year can make the inflation rate appear lower the following year when those high prices are the base for comparison. Similarly, if prices fell sharply in the base period, the current inflation rate may look unusually high. Because of these distortions, base effects can make headline inflation numbers misleading if we do not consider the price levels in the base period. This is why many economists look at core inflation, which excludes volatile items, or use other methods to adjust for base effects to get a clearer picture of underlying inflation trends. Understanding base effects is important for policymakers, businesses, and consumers. For instance, a sudden drop in headline inflation might not indicate a real improvement in price stability but could be due to a high base effect from the previous year. Likewise, a spike in inflation might partly reflect a low base effect rather than a true surge in price pressures. In essence, the base effect can cause inflation numbers to appear higher or lower than the actual price changes would suggest. Recognizing this helps provide a more accurate understanding of inflation's drivers and manifestations.